The money in your bank account doesn't actually exist. This isn't a metaphor, and it's not a conspiracy theory. It's simply an uncomfortable reality. If everyone tried to withdraw their money at the same time, the system would collapse within hours because that money isn't physically there. This isn't a mistake or a malfunction. The global financial system was deliberately designed this way. It's such an old and deeply embedded structure that most people accept it as either normal without questioning it. It's called fractional reserve banking, and it is the quiet engine behind global debt, inflation, and the illusion of wealth. To understand how we arrived here, we need to go back to a time when money wasn't just numbers on a screen. In medieval Europe, money was gold and silver. Wealth meant coins in a chest or valuable jewelry. But carrying gold was dangerous, so people began storing it with goldsmiths who had secure vaults. In return, they received a paper receipt promising they could reclaim their gold at any time. Soon people realized they didn't need to carry the gold itself. The paper was accepted just as readily and was far more convenient. That's where everything changed. The goldsmiths noticed a crucial pattern. Almost no one came to withdraw their gold at the same time. If 100 people deposited gold, maybe one or two showed up on any given day. The rest stayed untouched. So they asked a simple question. If no one is asking for it, why not profit from it? They began issuing more receipts than the gold they actually held. If they had 1,000 coins, they issued 2,000 receipts and lent the excess out at interest. They were earning money on gold that didn't exist. As long as everyone didn't demand their gold at once, the system worked. So, money was being created out of nothing. This wasn't a small trick, it was a historical turning point. Once people accepted paper promises as equal to real value, but it became detached from physical reality. Banks emerged as the institutional version of this practice, and governments soon followed. When the Bank of England was founded in 1694, its purpose wasn't to serve the public. It was created to lend to a government drowning in war debt, money it didn't have, while collecting interest paid through taxes on ordinary people. The pattern remains the same today. The United States followed a similar path. Banks issued banknotes redeemable in gold, but quickly realized they could issue far more notes than they had gold to cover. Periodic panics exposed the illusion, bank runs, collapsing institutions, and public fear. Each time the response was not to abandon the system, but to expand it. Central banks were created to preserve confidence. The message was clear. Even if the money isn't there, people must keep believing that it is. Now consider the modern system. Deposit $100 into a bank. You assume it's sitting there waiting for you. In reality, the bank keeps only a small fraction. Historically, that might have been 10%. The rest was loaned out, spent, redeposited, and loaned again. Eventually, that original $100 could support nearly $1,000 in circulating credit, but only a small portion physically exists. The rest is debt. Even that model is outdated. In the United States today, reserve requirements are zero. Banks are not required to hold cash against deposits. What limits them now isn't reserves, but capital and liquidity rules written under the Basel framework by unelected technocrats. Banks no longer lend out deposits. They create loans first, and deposits appear afterward. When you take out a loan, the bank doesn't pull money from a vault. It creates new money digitally. That money exists because you agreed to repay it. That's why most of the money in circulation today isn't cash or central bank money. It's bank-created money born as debt. The consequences are unavoidable. Inflation because money continuously expands. Permanent debt because money enters the system through borrowing. And concentrated power because those who control credit profit from money they never truly had. When the system stumbles, 1929, 2008, the pattern repeats. Trillions are created to stabilize it because without this structure, the modern economy cannot function. Here's the uncomfortable truth. The system cannot survive without debt. If everyone paid off their loans, the money supply would collapse. Participation isn't optional, it's required. That's why money isn't wealth. Real wealth is knowledge, skills, productive capacity, and independence. Things that can exist outside the cycle of debt and inflation. This isn't about fear, it's about awareness. Understand how money works, and you can begin to protect yourself. Ignore it and you continue playing a game where the rules are written by others. And remember this, the system doesn't stand on gold, it stands on confidence. And once confidence is lost, nothing can hold it together.